All right, I might get started. Welcome to ACCR's 2022 webinar on Woodside. Today we'll be discussing the shareholder resolutions that we have filed with the company, as well as presenting our analysis on the company's Say on Climate or climate transition plan for its Say on Climate vote, as well as providing comment on director re-elections at the AGM as well. For those of you who don't know me, my name is Harriet Cater. I am the climate lead for our national climate team here at ACCR. I'm joined by my lovely colleagues, Alex Hillman, who I'm going to request that he puts himself on mute now, as well as Naomi Hogan, our strategic projects lead. Alex is our carbon analyst. I'm joining you today from the unceded Ngunnawal and Ngambri country in the ACT. A bit of housekeeping before we get into the formal proceedings. This webinar, like all ACCR webinars, is being recorded, so please note that. We will have a Q&A at the end of the discussion on the resolutions and the Say on Climate vote. So please add your questions as we work through the content. We'll address any questions that are easily addressed, such as can we have copies of slides and things within the Q&A portal. Otherwise, I'll facilitate hopefully a lively and interesting chat with Alex and Naomi at the end of the presentations. Before we kick off, Naomi, I'll just move to the next slide. We just want to acknowledge the sort of extraordinary time that humanity is in at this moment. The impacts of climate change are escalating all around us, as witnessed just recently in the devastating flooding in Lismore, as well as extraordinary heat waves raging across India and Pakistan, extraordinary heat events in the Arctic and Antarctica, as well as a mega drought that is raging across the Western United States. Climate change is absolutely here. We've had two major IPCC reports handed down this year, the first being the Working Group 2 report on impacts, adaptation and vulnerability. And that the summary for policymakers was concluded with this statement, stating that any further delay in concerted anticipatory global action on adaptation and mitigation will miss a brief and rapidly closing window of opportunity to secure a livable and sustainable future for all. And we all have a role to play here in this transition, but I'd just like to conclude by emphasising that institutional investors have a specific amount of power and level of influence to see us transition at a rate that we absolutely must in order to ensure that safe future for all. I will now throw to Naomi to talk to our first resolution with Woodside relating to climate-related lobbying.
Thanks very much, Harriet, and thanks everyone for joining us. I want to start with why lobbying matters. And for us, it's critically important to indicate where a company is headed and what their forward priorities are, and also to acknowledge that in the past, negative climate advocacy has held back the policies that we've needed. And have led to the situation we're in now with that rapidly closing window that Harriet noted. I want to acknowledge AP7, who are co-filing on this resolution on lobbying that we're putting to Woodside, and also note their work on the new global standard for responsible lobbying. Charlotta has a quote here as part of that initiative, that investors will no longer tolerate a glaring gap between a company's words and their actions on climate. They're committed to engaging collectively and individually with companies and to escalate this stewardship where required. And we see our resolution as part of this important initiative. I also note that in the recent mitigation of climate change report by the IPCC, it was acknowledged that one factor limiting the ambition of climate policy has been the ability of incumbent industries, such as the big fossil fuel industries, to shape government action on climate change. And the report singled out Australia and the US and campaigns by oil and coal companies against climate action as some of the well-known and largely successful of these. And I'd also note that as the gas industry rises in its power here in Australia, we've become the world's largest LNG exporter, that pressure from an incumbent industry is also now playing out. So our resolution calls that shareholders request our company cease all private and public advocacy, both indirect and direct, that contradicts the conclusions of the IEA and the International Panel on Climate Change on 1.5 degree alignment, including advocacy related to the development of new oil and gas fields. Why this resolution is in part, because we've recently been hearing from companies such as Woodside that 1.5 alignment or even the sustainable development scenario under the IEA are just, one or two pathways as part of many pathways that are possible. We really want to emphasise that the only pathways that are Paris aligned are the net zero emissions pathway or the sustainable development scenario pathway, and that the net zero emissions pathway is the most equitable and feasible and cost-effective pathway. And as part of that pathway, we need to see gas demand and production decline from now and more rapidly into the future. However, we're seeing Woodside and its industry associations advocating to increase gas exports and unlock new gas fields across Australia. We've seen Woodside heavily engaging on climate and energy policy since 2018. This is a graphic put together by Influence Map that have done a lot of work looking into each of the companies and their advocacy. We see Woodside there as the number 3 company in terms of engagement, and we're seeing it in a D- score there, which is obstructive climate policy engagement. So when we look at some of Woodside's direct lobbying examples, certainly one that made headlines across the country in 2019 was when Woodside led the pushback against the WA EPA greenhouse gas guidelines. We saw that with a huge advertising campaign and political pressure to prevent policies that were flagged by the EPA that would have helped reduce emissions. We're seeing Woodside continue through current advocacy to federal government inquiries to advocate for gas expansion, including the Browse and Northwest Shelf expansion. And something concerning that we don't see from all companies, but Woodside has come out here on top. It was the largest political donor of fossil fuel producers for 2020 and 2021 financial year, giving 124,000 to the coalition and 108,000 to Labor. So totaling 232,000 during that financial year in political donations, which that's shareholders' money basically being spent there. It's known that that sort of donation is to get policy engagement and win favour from governments. And this is something that we think deserves greater scrutiny. With regard to industry association reviews, we note that Woodside has not published a review of its industry association since October 2020. When it did do that report, it only considered top-line support for Paris Agreement and net zero emissions, but didn't dig in to assess advocacy, particularly for new oil and gas development, or advocacy in support for subsidies of new oil and gas infrastructure, or advocacy on emissions reduction policies. Woodside has stated that it will continue to monitor climate positions of its industry associations through reviews within their executive steering group and committee, but Woodside doesn't state whether these reviews will be disclosed to investors, which we feel would be an important step and better practice to ensure investors are involved in this conversation. We note again from Influence Map's rating and detailed research of these industry associations that we can see the Australian Industry Gas Greenhouse Network, AEGN, APR, Chamber of Mines and Energy over in WA, and the International Association of Oil and Gas Producers, all getting a score again that puts them in that obstructive climate policy engagement area, which is of concern when we know we need to be aligning lobbying with the Paris Agreement and with 1.5 degrees. I note that nothing in the resolution from ACCR is calling on Woodside to exit these industry association groups, but to better use its power and influence, its financial contribution to these industry associations to shift from the negative policy advocacy that we're seeing at the moment into positive climate advocacy. Instead, we've certainly seen ACCR in the last few years going hard. After COVID happened, we've seen this push for a gas-led recovery, and report after report from ACCR, again pushing new gas field developments, bigger subsidies for the gas industry to promote more pipelines, infrastructure, and pushing those messages that we need an expanding gas industry in Australia, not one that is in line with the Paris Agreement and 1.5 degrees. ACCR's advocacy includes this questionable statement around gas having a growing role to play in decarbonisation, which is not in line with those pathways we outlined, pushing that state and federal governments should open up new areas for exploration and incentivise and subsidise development of uneconomic basins, supporting net zero by 2050 in name only, supporting the widest range of international carbon offsets, arguing that decarbonisation of the oil and gas industry is through technology rather than actually reducing the supply and demand of gas, which we need to see in those pathways, claiming that Australian gas can decarbonise Asian economies without thorough evidence and ignoring the opportunities for renewable energy, advocating for the promotion of LNG in trade negotiations. And one concerning trend that we've picked up recently through tracking advertising is we're actually seeing ACCR and some of the other gas networks pushing against policy that would help households to get off gas and to decarbonise at home or in their business, and pushing for new gas connections, which is obviously not where we need to go, and against that sort of argument that we hear that, oh, we're simply meeting demand. Actually, the gas industry and Woodside, as part of that, are pushing to increase demand. So I will leave it there and pass back to Harriet. Thank you.
Thank you, Naomi. You'll stop sharing. Thanks for the question in the chat. We have noted it and we'll address it at the conclusion of our presentations. So I am presenting on our second shareholder resolution with Woodside, which focuses on the decommissioning of end-of-life oil and gas infrastructure and the associated disclosures relating to the provisioning for decommissioning. So this is the text of the resolution. It is a request for enhanced disclosure, enhanced annual disclosure from 2023, seeking that a list of all onshore and offshore oil and gas infrastructure that may be decommissioned over the medium term is disclosed, along with audited asset level provisions for that decommissioning and disclosure of the major assumptions that are underpinning those provisions. Currently, for those who are familiar, usually it is a single value for provisions that is disclosed, along with relatively broad disclosure of assumptions. And our third ask in the resolution is that analysis of the useful life of all assets using different oil and gas demand scenarios is undertaken, including the IEA net zero by 2050 scenario. There is a relationship here between decommissioning risks and decommissioning timing and transition risks. So why did we file this shareholder resolution? Here's a quote from Saul Kavanagh at the ACCR conference last year, in which he told the room that decommissioning is the biggest industry time bomb that's just waiting to go off. Even the big boys, and we think he's referring to Santos and Woodside here, it's going to have impacts on their balance sheets. All the numbers in this sector are on debate, and this is an area where it's all bad news. There's been various sort of pretty astronomical estimates of the total decommissioning bill for Australia's oil and gas industry. This is coming out because the industry is reaching a level of maturity where there are a number of assets that are at or nearing end of life now. So in 2020, Wood Mackenzie estimated that it's about $60 billion will need to be spent to decommission infrastructure over the next 30 years. However, before you assume that this is an issue for tomorrow, at least half of that spend is anticipated to need to be incurred before 2030. Decommissioning is a really technical, complex challenge. It brings together a range of commercial, political, engineering, execution, operational and legal risks. And until quite recently, industries standard tactics to avoid the expenditure, because naturally, this is pretty dead money for them, so they'd like to avoid having to spend the money if they can. The tactics have been to sell assets that are at end of life to avoid the cleanup bill, or just to delay decommissioning for as long as possible, just sitting on the assets once they've reached end of life, or to dump them, to argue with regulators that the infrastructure can just be left in situ. These are no longer guaranteed options available to industry due to recent changes in legislation and enhanced regulatory oversight. And I'll touch on Woodside's role in that soon. And this has a direct bearing on company provisions, or it should, because it means that more money will need to be spent on cleanup, and we should be seeing an increase in provisioning as a consequence. There is a near universal acceptance that company provisions are understating the actual costs, and a peer-reviewed study in the North Sea proved this. It found that actual expenditure was about 71% higher on decommissioning than what had been provisioned. And it is ACCR's view that current disclosure practices don't provide investors with sufficient information to understand and assess this risk. That, each year that passes is growing, because each year that passes, the decommissioning task is 1 year closer. We pulled this slide together more for an international audience relating to Woodside's Northern Endeavour fiasco, but perhaps it's a good refresher for those of you who are in Australia as well. So as mentioned, Woodside's conduct has actually been the catalyst for some changes to legislation in Australia and enhanced regulatory oversight. In 2016, the company decided to sell a late life FPSO oil production facility, the Northern Endeavour, to essentially a startup called Northern Oil and Gas Australia, NOGA. The sole purpose of that transaction was to avoid, the estimated $350 million cleanup. Perhaps unsurprisingly, NOGA was entered administration and was not in a position to fund those decommissioning works, and so the federal government ended up having to intervene. And it initially looked like the costs were going to fall to taxpayers, which is a pretty nasty thing for voters to be considering, and perhaps not popular, certainly not popular. Estimates of the cleanup of Northern Endeavour are now ranging between 600 million and $1 billion. So you can see the significant contrast there between the initial provisioning from Woodside. The government has now passed a piece of legislation which transfers the cost for this cleanup back onto offshore oil and gas producers through this offshore levy, which is 48 cents per barrel to fund the decommissioning of the Northern Endeavour. You can see the snapshot here of a media coverage on this. Woodside is far from popular, considering its peers are also now having to contribute to the cleanup of its mistakes, with Chevron being pretty grumpy. In addition, to ensure that this doesn't happen again, the government has introduced trailing liability legislation, which means that original title holders will retain decommissioning obligations after any sale, particularly in the instance where the party that acquires the asset is no longer in a position to fund the decommissioning works. And that swiftly killed off ExxonMobil's plan to sell its Bass Strait assets, which have also got a pretty astronomical decommissioning task ahead of them. And that's relevant to Woodside as well, because BHP Petroleum is a joint venture partner in those assets. So yeah, it's the Northern Endeavour sort of fiasco and the BHP Petroleum merger that have really raised the profile of decommissioning risks for Woodside. BHP Petroleum does have significant imminent obligations in the Bass Strait. There was certainly a lot of concern around what those provisions might be when the proposed merger was first announced. Because BHP discloses its provisions at a group aggregate level, it was not understood what share of that the petroleum division comprised. But in 2021, BHP disclosed the petroleum specific provision to sort of address those concerns. And you can see that in the table here, it came in at $3.9 billion. The market was generally, it was lower than what the market was expecting. So there was a general sigh of relief across the marketplace about the risks that this posed to the merger. However, no assumptions were disclosed around the basis for the quantification of that provision. So it is our view that general sense of state of calm due to that lower number is not necessarily justified. And we'd certainly want to see enhanced disclosure on the assumptions behind the BHP assets in future years. We found out soon after filing out this resolution with Woodside that ASIC has actually been investigating the company for under-provisioning in 2020 in its 2020 annual report. ASIC was concerned about the offshore assets that Woodside had not included in its provision for full removal. And we think that was the catalyst for an improvement in disclosure in Woodside's 2021 annual report. So the report provides better insight to the sort of overarching assumptions that are underpinning its provision, being the Woodside specific provision of 2.2 billion that you can see in that small table. But importantly, the assumptions still assume a significant share of offshore infrastructure will be left in situ, and there were no specifics provided around which assets and the potential timing. We know that recent approved decommissioning plans for Woodside assets are, and what NOPSEMA is requiring of the company, are at odds with those assumptions in the annual reports. NOPSEMA is, wherever possible, expecting the company to remove all infrastructure. So that's important to bear in mind with regard to the risks around under-provisioning. And the memorandum, the merger explanatory memorandum that was released a few weeks ago just highlights how significant the work, that there are significant works coming up throughout the 2020s for decommissioning, both Woodside, sort of existing Woodside assets, and also those that will likely be picked up post-merger vote. So Woodside's response to the resolution: Woodside has recommended shareholders vote against the resolution. It is their view that recent improvements in disclosures address our ask, particularly relating to what was provided in the merger explanatory memorandum. This chart here is taken from that memorandum. You can see here that there's indicative costs over 5-year periods out to 2061, and an indication of which assets will be decommissioned in that period. It's also pretty apparent how significant those BHP Petroleum assets, how much they add to the decommissioning task, particularly over the next decade or so. Whilst we welcome this enhanced disclosure, Woodside is very much seeing this as a once-off. And the company itself recognises that this is subject to a range of potential material changes relating to regulatory approvals, the progression of specific asset level plans and works, and the standardisation of approach and scope when the BHP Petroleum, or assuming the BHP Petroleum assets are integrated into Woodside. So this is a snapshot, a point in time of what the decommissioning task might be. Our argument is that the evolving nature of this material risks warrants granular annual disclosure rather than just a once-off. Within the independent expert report that was also provided recently to underpin the merger, some asset level cost profiles were provided, which also included decommissioning and restoration costs. You can see the orange bar, decommissioning is represented with the orange bar here for the Macedon, BHP Macedon asset. So this also demonstrates that asset level disclosure which is what we ask for within the resolution, is possible. Woodside hasn't sort of publicly pushed back on that. Santos certainly has in stating that it would require them to disclose commercially sensitive information. But Woodside has shown what is possible in these once-off disclosures, and we would love to see similar levels of disclosure on an annual basis moving forward. So to conclude, our rationale to support, Woodside has really mishandled the issue of decommissioning to date. The BHP Petroleum merger will only elevate this issue for the company. We believe shareholders require detailed annual disclosure on this issue. As we've highlighted, there are genuine risks with under-provisioning. ASIC agrees, having initiated that investigation into Woodside. Enhanced sort of asset level disclosure will give investors a capacity to gain greater confidence around under-provisioning risks, essentially enabling sort of somewhat of an audit of that total number that is being disclosed. And as Woodside has shown, it is entirely possible to enhance disclosure on decommissioning without disclosing commercially sensitive information. They themselves have proven this with the merger documentation. And to conclude, climate change transition risks can affect provisioning, and investors need to know that companies are stress testing provisions under low demand scenarios. We do have some concerns regarding the metrics that Woodside has used for its scenario analysis, and Alex will be touching on that when he talks through the company's transition plan. So at that, I will cease sharing and throw to you, Alex.
Yeah, hopefully that's come up now. So yeah, my name's Alex Hillman. I'm dialing in from Whadjuk Noongar country in Fremantle over in Western Australia. So yeah, this is Woodside's issued a climate transition report earlier on in the year. So this is ACCR's assessment of that report. Before we go into the details, I know Harriet mentioned the criticality of 1.5 degrees. I think the urgency of 1.5 degrees is really necessary to understand as well. And the Say on Climate vote is specifically designed to empower investors to manage climate risk within companies, and it's entirely up to investors about how strongly that is used. So we strongly encourage investors to take that opportunity to support the science and drive corporate behaviour, including with Woodside, to support a 1.5 degree outcome. So ACCR, I think it was Harriet also mentioned that or maybe Naomi mentioned that the IEA publishes a 1.5 degree pathway called the net zero emissions scenario. We hear pushback from corporates, especially that there's many scenarios out there, and the 1.5 is just one of them, and countries such as Japan are not following this. So we still place a really high weight on the net zero emissions scenario because the IEA itself says it's the most technically feasible, cost-effective and socially acceptable pathway to meet 1.5 degrees. And also we hear it from the investment community. So IGCC says that the NZE is actually a good start. For the energy sector, it's sufficient to meet 1.5, but it's actually maybe not ambitious enough to manage global climate change because other sectors are going to be harder to decarbonise. So, you know, that introduced an argument that the NZE isn't actually ambitious enough to meet, sensibly meet a 1.5 degree outcome. But we're definitely not shying away from how bold, ambitious, and how much of a massive deviation the NZE is from business as usual. That graph I've pulled out on the right there is LNG exports under the NZE, and you can see from 2025 on, like LNG exports just collapse. So it's basically LNG exports decline as fast as reservoirs, which means there's no new need for oil and gas developments. So it is dramatic, but it's also the best bet we've got. So we keep on coming back to the NZE wherever necessary. So quickly, a run through of what I'll cover is a brief reflections on Woodside's report and key observations, Woodside's emissions and targets, their decarbonisation strategy, the capital allocation framework and capital allocation projections, their scenario analysis, and then our overall conclusions. So this isn't the first time that there's been a vote on climate change at Woodside. In 2020, so 2 years ago, there was a vote where basically just under half of Woodside investors support ACCR's resolution for Paris-aligned targets. We think that Woodside hasn't responded sufficiently. And so we just remind all investors that Woodside hasn't issued their climate report in isolation. They've issued their climate change report within 18 or less than 2 years from half of the investors asking for a more dramatic response to climate change. When we look at what their report says, they've just restated their scope 1 and 2 equity share targets. They haven't included a scope 3 target. They've got what they call a scope 3 plan. They've attempted to describe their targets as Paris-aligned. Most, in fact, all of their emission reductions are going to be delivered using offsets. They have a new capital allocation framework, but their capital allocation is far from 1.5 degree aligned, and they have published a more granular scenario analysis, but we don't think it paints a terribly optimistic picture. And one thing to note is that their climate report, at times it depends on BHP deal going through, but it excludes the BHP assets. So they've walked a bit of a fine line. You know, their rationale is that until the merger is executed, they have to exist as two separate companies and keep information separate between the two. So firstly, looking at Woodside's emissions. and their targets. So that graph shows the last 3 years of Woodside's emissions and then the last year of BHP's emissions. So they disclose on different timeframes, but I think so Woodside on calendar year, BHP on financial year, but I think the general trend, but there's similar size portfolios that are going to merge into a combined entity. But the really key bit in there is that the yellow bars at the bottom, the scope 1, and the invisible, immaterial scope 2 bars are all that's covered by Woodside's target. So they have an equity emissions target covering scope 1 and 2 emissions. And in the last reporting year, calendar year 21, that was just 9% of emissions. So Woodside's described its targets as Paris aligned, but they actually exclude 90% of Woodside's emissions. So we think it's a bit disingenuous to describe something which covers 10% of a portfolio as Paris aligned. And it contradicts Science Based Targets Initiative, which requires deep cuts to value chain emissions, including a halving by 2030. And again, investor groups have stated that it's insufficient. So IGCC and CA100 Plus specifically call out fossil fuel companies, saying that scope 3 emissions need to be covered by targets. Something that Woodside has done, which again is cherry picking at best, is they've articulated a target for their scope 1 and 2 emissions based off net emissions, except they've taken a baseline using gross emissions. So I'm not sure if all investors understand the difference. So the definition of gross emissions is before offsets are accounted for, and net emissions are after offsets accounted for. So they've had a look at emissions, historic emissions, before they count for their offsets, and said, including offsets, our emissions are going to be lower. They haven't disclosed what their offset use was during their baseline period. So we've made some assumption, or one key assumption, that a regulatory commitment at the Pluto asset was met. So there's a regulatory commitment for Pluto that all reservoir CO2 vented is offset. So we've said, if that condition was met, what would the baseline actually be? And it turns out the baseline would be 8% lower. So Woodside's got a 2021 target to reduce net emissions relative to a gross baseline by 10%. If that same emissions outcome was reflected on a net emissions target and a net emissions baseline, it would actually just be a 2% emission reduction. So their 10% sounds like it's a big deal, especially over 1 year, but a 2% target is much less ambitious. When you look at their 2025 targets and 2030 targets to reduce net emissions against a gross baseline by 15 and 30%, if you adjust the baseline, it actually changes to 7 and 24%. That's on the premise that Woodside can use offsets. Our view is that offsets shouldn't be considered as a substantial reduction. If you had a look at emissions, what their targets actually mean on a gross baseline, so gross emissions baseline and gross emissions outcome, they're actually looking at a 1.6% reduction this year. And by 2030, they don't have a target, but their own projections suggest that their emissions will increase by about 10%. So just taking their target and their plan to reduce emissions by 30%, or their net emissions by 30%, they've got 3 different levers that they talk about, and we'll talk about each of those. So their baseline of 3.5 million tonnes of gross emissions, the first thing that happens to 2030, or the first thing in this graph out to 2030, is that their emissions are going to increase. So their gross emissions will increase by about 1 million tonnes. This doesn't just show that their scope 1 and 2 emissions, which are covered by their target increase, their emissions are going to increase because their production is going to increase. And so that 90% of their emissions, which are actually excluded from the target, are also going to increase as well. So it's a really key insight from this graph is what it doesn't explicitly talk to. And then in terms of their 3 levers, the first lever they have is design out. So they've got about 500,000 tonnes of emission reduction there. That reflects a genuine improvement of Pluto, the LNG train at Pluto 2 relative to Pluto 1. So it's arguable whether or not being better than historic equipment is sufficient, but there is an improvement in the emissions intensity of Pluto 2 compared to Pluto 1. But what it does do, it's not a zero emissions train or LNG train, and it's not an LNG train which could readily be retrofitted for zero emissions. So even though it's a bit better than Pluto 1, it locks in emissions in post 2050 when Pluto 2 is still planning to be operating. The next lever they have is operate out. and they've set themselves by our counts and our reading of this graph, they're chasing a 4% improvement in operational decisions. So these are things which don't typically cost money. You know, you might do a risk analysis to make sure that you can safely operate the facilities in a different way, but then you just change some set points or open or close some valves. That 4% ambition over 10 years compares to what they delivered in the 5 years to 2020, which is 8%. So they're chasing half the ambition in twice the period for things which have a massive payback. So we think that doesn't reflect the urgency of climate change. Then the last pillar they have is offsets. So I mentioned earlier on that offsets are going to deliver all of their emission reductions. Before offsets, you can see that dotted line there showing how the baseline would trend. Offsets start above that line. So emissions before offsets are actually higher than their baseline. And so it's about 140% of their target is being delivered by offsets. This graph just reflects projects which are in operation or sanctioned. They've also announced an aspiration to build H2 Perth, which is a big chunk of H2 Perth will use fossil natural gas to produce hydrogen, and they've said that they'll offset those. So if that project gets sanctioned and they retain their target, their reliance on offsets or the use of offsets will increase by 40% above this level, which is already more than all of their emission reductions that they're targeting. They issued another graph when they announced the BHP deal last year, and although the numbers are different, it's essentially the same, where there's production growth showing that Scope 3 as well as Scope 1 and 2 emissions increase. They have some design improvements, some operational improvements, but all of the reductions are delivered through offsets. That it's arguable whether or not offsets should be considered as an emission reduction tool. And we think there's very strong arguments that they shouldn't be allowed, and that you should actually be reducing emissions instead of offsetting them. So again, in investor groups, IGCC and CA100 looking very strongly for strategies to avoid or minimise as opposed to offset. Science-Based Targets Initiative says that offsets should be treated as additional instead of emission reduction tool. They should just complement and be additional to those genuine emission reductions. I'm sure everyone's aware that there's been massive criticisms from extremely credible sources of Australia's offset crediting mechanisms, which even for a well-governed democracy like Australia, when there's such extreme risks around the sincerity and the additionality of offsets, reliance on them should be called into question. And IPCC as well. So same as those investor groups and SBTI, IPCC is calling for actual reductions in emissions, not just offsets. So one thing that's really crystallised this for me in recent times is the difference between the offsets that most entities are looking to use, which are generally land sector offsets. So fossil fuels will be a stable store of carbon for millennia, thousands, typically millions or tens of millions of years. When you put carbon in a forest, or you just don't take carbon out of a forest, such as avoided deforestation, there is a real chunk of carbon in those trees, but the stability of that carbon sink is not stable over geological timeframes. So especially with climate change accelerating, it's false to compare or to pretend that biospheric carbon can cancel out an emission from a fossil-based carbon source. I won't go into this slide too deeply, but one of the things we hear from oil and gas companies is that as soon as the Science-Based Targets Initiative issues a methodology for fossil fuel companies to get accredited with a net zero or a science-based target, they'll develop one. So Science-Based Targets Initiative hasn't issued, as the oil and gas companies say, they haven't issued a methodology to accredit a science-based target for the fossil fuel sector, but they do have broad principles. Woodside's targets meet half of one of those 4 principles, and that's to have multiple targets for short, medium, and long term. They fail on the rest of the principles. I'm pretty sure we'll share these slides so you can look at that in detail. So Woodside has made improvements to its capital allocation framework. So previously, it just had investment thresholds about when they would make final investment decisions. And what they've now done is they've articulated different thresholds for oil projects, to gas projects, to renewables, to what they call new energy projects. so this acknowledges that lower carbon types of investment have different risk profiles and then lower returns to justify those. So that's a positive step forward. When you look at expected capital investment through the 2020s, though, it's still blindingly obvious that most of the investment is still allocated to fossil fuels. And the hydrogen, they're talking about $5 billion of hydrogen, and that's the bulk, that's the only substantial part of their Scope 3 plan. That $5 billion is just 12% of what a combined Woodside and BHP portfolio will invest through this decade. And you can't take BHP out of this because that $5 billion is explicitly dependent on the BHP deal going through. So if we fully expect the BHP deal to be executed, but if it doesn't for any reason, then that $5 billion hydrogen target is no longer valid. When we look at that hydrogen investment, I mentioned H2 Perth has a big chunk of fossil methane, which is going to be used to make hydrogen. So, for the same reason that offsets aren't valid, we think hydrogen should be produced from renewable energy, not fossils. And even the rest of their hydrogen portfolio, which isn't from fossil gas, it's still it's electrolytic, so it'll use electricity to split water. But they haven't guaranteed that that's going to be green electricity. So even for the highlights, what Woodside would call the highlight of their Scope 3 plan, we think there's still some fairly serious flaws in their approach. Woodside, as well as talking about their targets being Paris-aligned, Woodside also says their new energy investment is Paris-aligned. So the way they define that is they have a look at the IEA scenarios and how much money is going to be spent on hydrogen in the Paris-aligned scenarios, and they say it's broadly in line with those two. So oil and gas companies, like many other companies, are notorious for selecting metrics that are easy to meet and make their decisions look attractive. So we don't think that more hydrogen necessarily fixes climate change, but it's pretty clear that more fossil fuels makes climate change worse. So instead of assessing capital alignment with Paris against hydrogen, what we think is a better metric is to compare fossil fuel investment against Paris-aligned scenarios. And on that basis, and in particular, as we mentioned earlier, the net zero emission scenario precludes any new investment in new fossil fuel, in new oil or gas fields. And there's that portion of investment. So if you see on the graph on the right, I'm not sure if my mouse is coming up, but there's that dark purple section there in the net zero emission scenario. That's a portion of spend to deliver projects which had already made final investment decision prior to the NZE being published. So Woodside is targeting new investments in new oil and gas fields in breach of the NZE. But even if you just look at the CapEx allocation, they're planning on spending more than 3 times as much developing new oil and gas fields as the NZE allows through. And this is through the 2020s. We mentioned that Woodside has published a more granular and more detailed scenario analysis. So things to like about the scenario analysis, it uses extremely well understood scenarios. So it uses the IEA scenarios from the 2021 World Energy Outlook, and it's broken down by time. So there's four periods of 5 years each, showing free cash flow over time. And I think they've included this quite proudly because it shows that free cash flow, at least over a 5-year average, stays positive in all scenarios on all of those four time periods or four periods. More readily compare these scenarios, we amalgamated them using a present value approach. So we just discounted those free cash flows at a notional 10%, so a nominal 10% discount rate to allow us a single value for each of those scenarios. And what you see there is a massive variation in future free cash flow. So from the highest emission scenario, the stated energy policy scenario, there's $25 billion of present value free cash flow compared to the net zero emission scenario where that metric drops by 70% to $7.2 billion. So having free cash flow being positive is better than having free cash flow being negative. But free cash flow doesn't consider debt repayments. So if your free cash flow is insufficient to cover your debt, then you actually become insolvent. So I'm not saying that Woodside will become insolvent in any of these scenarios, but what I'm saying is they've selected a metric which actually doesn't let them demonstrate that they're solvent. And it also lets them bypass discussions around debt full stop. our view is that if your future free cash flow drops by 71%, the chances of you maintaining a credit rating are quite slim. And it's quite likely that your credit rating will weaken and your cost of debt will increase. And so we would expect Woodside to see a nasty spiral where their access to debt will become constrained and having potentially disastrous consequences for existing shareholders. So at the portfolio level, that last slide, I think, demonstrates that Woodside doesn't have a portfolio that protects investor funds in low carbon scenarios. This is a more specific example. So it's from a report we published earlier, Facts Over Fiction, Debunking Gas Industry Spin. And it looks just at the Scarborough investment. So Woodside published its cost of supply of $5.80, so US $5.80 per million British thermal units. The IEA also published their view of the gas price in Japan and a few other jurisdictions as well, but this graph shows the gas price in Japan under the 4 different scenarios. So those 2 scenarios along the bottom, the sustainable development scenario in grey and the net zero emission scenario in blue, are Paris aligned. And you can see Woodside's cost of supply in that dotted blue line is higher than that. So this graph shows that Woodside says it's going to cost more to get gas to a Japanese customer than a Japanese customer will pay for that gas in a Paris-aligned scenario. So Woodside's actually baked in a final investment decision, which is dependent on the world not meeting Paris alignment, not meeting the Paris objectives. And it also shows, but it won't mean that Scarborough will stop operating. So once Scarborough spends its $12 billion to get started, its ongoing costs will be quite low. So it'll continue to generate cash, even though it won't generate sufficient, or it won't meet its target equity returns. I think this is a nice complement to the previous graph, which showed that future free cash flow can be positive even when investor returns aren't being met. So in summary, Woodside's 2021 climate report reflects an inadequate plan to manage climate change. It doesn't attempt to reduce Scope 3 emissions, which are more than 90% of its portfolio. Its Scope 1 and 2 strategy is to increase emissions and then has an over-reliance on offsets to meet a target which uses a cherry-picked metric. Its capital allocation framework is improved, but its capital allocation is far from 1.5 degree aligned. Even the hydrogen investment targets are heavily weighted towards fossil-based hydrogen, and its scenario analysis shows the portfolio doesn't protect shareholder funds under Paris-aligned scenarios. So on the basis of that, ACCR recommends that investors vote against the Say on Climate resolutions. We vote against the re-election of Anne Pickard. So she's the chair of Woodside's Sustainability Committee, and we think that role has a heightened responsibility for Woodside's climate change plan. And then I think investors should take the next 12 months or until the next round of reporting to forcefully engage with Woodside to strongly support them to develop Paris-aligned Scope 3 targets, Scope 3 strategy, and Scope 3 capital allocation. And that's the end of the presentation.
Thank you very much, Alex. It was such a luxury to have the time to actually go through that in detail. We've had some very, very tight timeframes for presentations this AGM season. We have got, before you relax, Alex, there are a couple of questions here in the chat that may be best for you to answer, although Naomi, speak up if you were going to take the first. So the first one came in early in the session asking, does the statement that gas needs to decline include the possibility that gas plus CCS will be needed to generate hydrogen as stated in the IEA NZE scenario? If so, by how much?
So you frequently hear oil and gas companies talk about niche uses for oil and gas as if that justifies further investment. So, but when Naomi showed that graph of future gas demand, that included all uses of gas, including gas sequestered with CCS. So it included, industrial growth through Asia. It included, increased gas use in India. It included gas use for hydrogen and blue hydrogen where it's sequestered. So the main thing to understand about that is these arguments for gas aren't additional to a declining gas curve. They're already incorporated in a declining gas curve. In terms of the role of CCS in future gas use, under the NZE, it's about 10% of gas use in 2030 is expected to be coupled with CCS. And then by 2040 or 2045, it becomes the majority of gas use. So if you don't have faith that CCS is going to work, then gas use has to decline even faster. So especially kind of beyond 2030, beyond 2035, there's a dependency on CCS. So it's not an additional opportunity for gas, it's actually a dependency on CCS working.
Thank you very much, Alex. And there's another question here that I think you are best placed to address. So with the statement that the NZE excludes investment in new fossil fuels, do you think that this also includes projects to maintain existing supply?
So it does, the NZE does allow for significant investment in oil and gas, but it doesn't allow for any investment in new oil and gas fields. So continuing the operation of an existing oil and gas facility requires some ongoing capital, and that is allowed and modelled into the NZE.
Great, thanks so much. All right, there's no other questions in the chat. Please put them through. We have 6 minutes left. I have a question for you, Naomi. If we go back to the lobbying theme. Obviously, this is a bit tongue-in-cheek coming from me, but isn't Woodside using its political influence to further its interests a good thing for Woodside's shareholders?
Thanks, Harriet. And this is something that we hear a fair bit in terms of, look, isn't the lobbying a good thing? Isn't it good if we can get more subsidies for the company? It does demonstrate power that is held by the company currently, yet it also demonstrates a vulnerability to be reliant on that level of government support, to be reliant on needing to make political donations to get the policy outcomes that a company requires, can only last for so long, and demonstrates that potentially the company is trying to push for policy outcomes that are not aligned with where the world needs to move, that are not aligned with the requirements of holders of the company that hold diverse portfolios that require the world to act on climate change and to prevent the worst climate damages and climate risks that will impact the whole of our economy and civilizations as we know them. So I think that while in the short term, that sort of lobbying and political influence could look like a good thing for the company, longer term and medium term and across diverse portfolios, it's entirely problematic. That sort of lopsided support might then prevent other aspects, other industries and climate and Paris aligned industries to be able to get ahead at this time and hold back the action that we need and the policies that we need and the positive lobbying that we now need to see companies like Woodside push ahead with.
Back to you, Alex. So Woodside has announced this $5 billion for hydrogen. It's $5 billion more than they'd committed last year. Isn't that actually a good thing?
I think that the thing with that is it is a step forward, but we don't need little step forwards. We need dramatic changes. So the IPCC has come out saying that we're in an emergency now. We need to see dramatic changes in how we invest and where our energy comes from. I think it demonstrates $5 billion demonstrates that Woodside is capable of doing this sort of thing. But unless they stop investing in new fossil fuels, new oil and gas fields, they can't pretend that their future is aligned with Paris.
And how much has Woodside invested in low carbon solutions thus far?
So the only thing I can think of that they've disclosed was when Pluto won. So Pluto made a final investment decision. They had an environmental obligation to spend $100 million on planting trees. And so they did that under duress from the government. Beyond that, I haven't seen any disclosure that they've spent anything. Bloomberg New Energy Finance actually recently published an analysis of different oil and gas companies, and their view was that Woodside hasn't spent anything. So 0.0% of capital has been spent on low carbon solutions since 2015.
Righto, thank you. Okay, we have 3 minutes left. I sort of feel anytime we talk about oil and gas sector and climate issues today, the Ukraine crisis, energy crisis comes up. Alex, does the Ukraine war mean it's okay for all oil and gas projects that are being considered to progress to FID?
so much to talk about with Ukraine.
Well, you've got 2 minutes.
Any entity, so any country or company that exports energy is salivating about the business opportunities to do with Ukraine. So Woodside's no exception. Woodside's starting to talk about Sunrise and Browse as future investments will start to make sense. I think this just demonstrates the recency bias that these companies have. So, it wasn't too long ago that oil and gas CEOs were talking about lower for longer and capital discipline. And that's gone out the window due to high energy prices today. Hopefully, the Ukraine crisis doesn't last for many years. Hopefully, we get over it and we have peace in Eastern Europe. And so, even acknowledging that Russia will remain a pariah and people won't want to buy Russian energy, what we're seeing in response to that desire to especially Europe wean itself off Russian energy is a huge amount of investment in energy efficiency and reduction in energy use full stop. So I can imagine a world where a company like Woodside decides to invest in Browse on the basis that Europe's going to need a whole heap more gas, but Europe comes off, starts weaning itself off gas, they stop needing Russian gas, and then they'll just keep going with energy efficiency. So it's easy to see a situation where Woodside decides to invest a huge amount of money in a project like Browse, and then by the time it starts actually producing, it's trying to sell into a market which is focused on energy efficiency and focused on domestic renewables. And that's just a recipe for destroying shareholder funds. So I sincerely hope that Woodside realises that this is a temporary situation and doesn't firstly profit from that unduly and put investor funds at risk.
Thanks very much, Alex. It's 2:00, so we will wrap up now. Thank you, everybody, for joining us. Big thanks to Alex and Naomi for your presentations today. It was really fantastic discussion. And please do get in touch with us if you have any follow-up questions regarding this content. We will email out our investor briefs on the resolutions and our Say on Climate analysis, along with a recording of this webinar to all attendees in the next day or so. So thanks so much. And please do get in touch if you need to.